and get out quickly with a profit. And that's the key. So with that said, I want to do something a little bit differently today. As you know, when you fly from the West Coast and you fly to the East Coast, it's an all-day event. It's like a beautiful view of the Strip. So it was neat to see the Strip at night like that, waking up, looking out the suite room window. And when we landed in Miami, because we needed a direct flight, and we had to drive back to North Palm Beach Sunday night, we got home and it was dark out. So with that said, it's nice to see daylight right now, be back in the captain's seat, and this week is going to be something, this week with the Black Friday and, of course, Cyber Monday, and how much of that might be priced into the market. I think what we see is a little bit of sector rotational grind. One thing that we've been doing a lot of in this room is we've been doing very selective trading. We've also been looking at day trade opportunities from points of which markets move up or down and break up or break down. So we've also done an amazing, what I believe, and some feedback from you guys, an amazing job of selecting. And when I gave some of the trades out at the expo and showed people this is what we've actually done, and this is some of our setups that we've looked at in some of the moves. I mentioned JDS Uniphase, QLogic. I mentioned Whole Foods, Qualcomm, the directional calls there. I mentioned Cisco and, of course, Amazon. And most of the audience had been quite aware of those big moves because those were the big earners surprises, right? I mean, we even joked about JDS Uniphase in this room saying, I forgot what the heck they do, but I remember the name from back in 2000. That's 13, 14 years ago, right? So with that said, I think the key element is I've heard some of the feedback is people were amazed at the nice calls but did not take the trades because they just didn't either have the excess capital because they were tied up somewhere else or didn't have the knowledge and experience of how many options to put together. Now, I'm not going to ask the room now for a poll of if that was your problem because I already know a third of you have that problem. I'm going to go through the Amazon trade because I went through this as just a quick review. Now, this week, we have an interesting concept. The stock market's back up to testing the 70 level. We filled that gap. We talked about Friday in the room. The market gapped higher. It's going to come back and fill the gap. I didn't think it would do it 4 hours later. And then in the overnight session, come right back up. And that seems to be what we're back to that normalized marketplace where we open lower, trade higher, come back down. Whereas Friday, we gapped higher due to China's lowering of interest rates, and then we trade back down during the rest of the day session. So today, the first thing I want to do for weekly planning and scanning is, because it is a holiday week, it's going to be a little thin. We've got today, we've got tomorrow. Really, how many people think that their attention span will be in the market on Wednesday, which is a quasi half a day for most traders in New York? They want to go somewhere. They have family. They're traveling. You know, the kids are coming back from college. Moms want to see the kids. Dads want to see the kids. So, and then Friday is, you know, generally, you know, an up day in the market, typically, because everyone's jubilated and happy, and it's Thanksgiving, and I don't know if that's the overall emotional reason why stocks go up on a traditional basis into the holiday. But then we have something that's been developing over the last 8 years, is more and more retail clients buy via online because they don't want to deal with the holiday mess. They don't want to deal with the traffic. The funny thing is when we go through Black Friday and Cyber Monday, some of my research has indicated that some of the department stores names, like the Macy's and the Nordstroms and the Kohl's and the Ross stores, they don't fare that great on Black Friday. It's more of regular retail, apparel stores, and other specialty stores that do better on Black Friday and, of course, Cyber Monday. One store in particular that we prepared for was Amazon. Now, we've scaled out of Amazon, and I'm going to go through if you did not take the trade in Amazon, and mainly because, as the feedback is from others, I just want to mention why people didn't want to do the trade. They didn't, A, think the market had the potential to get to the strike price of 355. B, were tied up with capital somewhere else. C, didn't understand options. Those were the three main feedbacks that I got. We went through Amazon from almost A to Z. We had a great move in both a daily chart with on-balance volume as just a reminder. We also had a very strong move based off old support. And we were looking for a pullback, hopefully to get back down in here. Or we mentioned look for a breakout above that swing high. Many of you might remember that. In fact, we had a high close doji. We talked about it in the room. Said these are out of the money options. And 355, we went with January to give the market the seasonal trend, which typically the market moves up going into December. I did not want to be in a November expiration. I didn't want to be in the December expiration, because what if the market moved into December, it came a week late, 2 weeks late, and came into the December expiration, we would lose theta. Directional options trading, when you're going with out of the money options, you got to also give yourself some time for the trade to mature. And I think that's one of the reasons people fail in directional options strategy trading. Just as a reminder, you guys know as a fact, in 1986, I retired at age 25 by trading bond options. Many of my trades were directional out of the money options. That was the year in 1986 that I had a testifiable 3,615% return, and I managed about 25 accounts. I managed people like my own accountant, who was with at the time Coopers and Libran, to a bunch of big name people. The amount of ability that I had for looking for directional calls, I had a very strong finger on the pulse of the market in those years, as I have had with other markets, based on the methodology that I use to this day and I teach to you guys. So when we go through moves that we have a high probability, you know, I look for selected, there are reasonable expectations that I look for of what can the market get to. In order to figure out, as I always teach, where can a market go, you have to answer yourself, where's the market been? So pinpointing the timing as to the market, it should go by a certain specific time and give or take a week or two. That's why you want to give yourself excess time on an option for a directional play. Why? And that is one of the main reasons we selected the January calls. Now the funny thing is, where has the market been? We have an old swing high up here. We have an old area of price acceptance where it broke out of another old high right here, and then rallied up and then failed. So right around that 355 area, and then if I use my the daily charts a little bit more, you'd find that 355, there's a small gap in the market from that week right there where we saw the market move lower. That was a bad earnings report. More importantly, our quarterly pivot resistance is 356. So 355, I said, if the market gets up there and it happens within the next 30 days, the strongest of all trending situations, if the market had gone up there in the strongest trend, then guess what? We would see an acceleration and a small delta. And I think my exact words is, some of you option theorists in the room, don't yell at me, but I think that delta was 13. And you guys, some of you have been taught, never touch a call option, don't buy premium, always sell premium, do vertical spreads instead. And you know, the funny thing is, a vertical spread, if a market goes up and straight down, a vertical spread, the market moves $20, $30, and your vertical spread does what? It moves 5, 6, 7, 8, maybe 10 cents. Whoopee-doo. And I think a lot of you are getting a little, if you do the debit spreads, a vertical call spread, for example, you're getting fed up with them most likely, because that was the feedback I got at the Traders Expo, by the way. So if it's in this room, you know, we do less vertical spreads. We do more credit spreads, more directional strategies, because that's what the market condition has been giving us. It hasn't been giving us opportunities for condors or butterflies. It's been giving more opportunities for directional explosive moves, such as the Q puts, such as the spider puts, such as reversing off the lows and the IWM calls. I mean, if you think about it, since August, September, we've had, you know, quite a few explosive moves in the market, and our analysis has been spot on in all of those, the majority of those moves. Now, we've had a little bit of problem using debit spreads, which are more risk contained with GLD. Twitter didn't amount to much, but it was very low risk. We said, get out of that. The S&P credit call spread, I said by Tuesday's close, if that doesn't work, LMO, RFN, and that was it. It was a small risk, and that's just the name of the game. But turning analysis, and I just wanted to go through this slide because I don't think it's fair to go through some really amazing material to teach to a Traders Expo. And, you know, on one hand, people took the time and the expense to fly out there, and a lot of people came out there just to see me according to what they said. They said, John, we just came out here to see you. And that was extremely nice. And every time I go out to one of the expos, I generally try to put out some concise, tradable information. And many of you have seen me at the expo and know that. But then I don't think it's fair that I have my own clients, my own family, my own friends, that I don't share that information. So I wanted to take time this morning to share these certain slides with you in today's planning and scanning. And I don't think turning analysis into executionable option trades needs to be very complex. And I think one of the things is how many positions should you be in? And many of you have taken my, of course, are Trading Trigger University students. And some of you took only the summer mentoring, which enhanced the TTU, because a lot of the information in the summer mentoring 6-week course was not contained in TTU. So it was an additional, kind of like an updated version of more education for trading. So I think what it is if we can start to look at how much money and time do we devote to maybe day trading, how much time do we devote to possibly position trading, and if we're going to put an option trade on, what should we be looking at? And, you know, many of you for years, and I mean, I know Bill McKee has finally reminded me, and I'll never forget now, Bill. Bill saw me in person the fateful day I had the pulmonary embolisms that we were doing that live trading event. And I went back and I saw in that, that PowerPoint slide, because believe me, I've kept every PowerPoint slide that I've done or tried to save since not just the 90s, which I don't have those anymore because this computer was stolen and I didn't have backup, but or the backup was stolen too, now that I recall. That's why I don't have it. But I have slides from doing presentations from 2003 at the Board of Trade with my friend Larry Pesavento, which I know I will share those slides probably this week in this holiday session with you guys. So with that said, I think it's in almost every presentation and in the teachings that I do, I give the amount of how to use proper position sizing ratio guidelines. And I think it's real simple, assuming a dollar amount based on a percentage of your account devoted per trade that you're willing to risk. So what does that really mean? Let's get down to it. If, for example, on November 11th, the stock is trading at the 308 level, the January 355 strike calls were trading at 157. In fact, the next day I said you can get into these things from 157 to 171 in that range, and the market had a pullback, and you were able to even get 150. I think they went down to 154. I think it was 156, somewhere around there. Anyway, limit price orders would have been filled. Now, let's say you have a $100,000 account and you're only risking 2% of your account on any one trade. That means you're going to have $2,000 to trade. That's the magic number right there. How much are you willing to risk? I don't know what each premium costs. When you just look at the premium risk, you don't know how many should I be in because you don't know what your risk is. So go and look at how much percentage of your risk to your account do you want to risk, and then you know it's $2,000. You can change and fudge these numbers. I don't know what each and every one of your account balances are to trade stock options, but let's say you only have a $20,000 account. Well, risking, that's $400. 2% of $20,000 is what? $400. So maybe you want to go 4% risk on that per trade, because you have to be in multiples at least, you know, as we teach. And Butch always used to do thirds, 1/3 in, 1/3 out, and then a runner. And you notice I do halves, 50%, because sometimes I do quarters. I'll get out of half the position, get out of another half of that, which is, what does that equate to? A quarter. So I've always been, from day one, a quarter kind of trader guy, scaling out. I've never been the pyramid scaling guy where I scale in and scale in and scale in. I might scale in over time, but I never have been able to master the pyramiding and Powerball playing, kind of like where you buy them and the market rallies and you buy more, and the market rallies and you buy more, and you pyramid and all the way up. Because the small little time you get a little correction, you're wiped out, because generally people pyramid heavier on the way up than they did, you know, on their base of positions, if that makes sense to everybody. So my style, it's real simple. First quarter position I said to get out. So if you were looking at this formula, 2% risk on a $100,000 account, you had $2,000 to play with the money, so to speak, on those options. So we were looking at the 355 strike for $1.57. You can round that up, say 170, 160, whatever you want to do, and then just divide how much money each premium was by the risk of 2,000, and you'll come up with the number. It's 13. If you don't like 13, go 14. If you don't like 14, go 12. But if that's your number, that's how many you get in. Even saying if you only did a 10 lot and you want to scale out of a quarter position, you can't get out of 2.5. So your first scale out would either be 2 or 3. Typically, if in that situation it's 3, then, you know, or a 10 lot, you do 3. And we got out on a scale out at around 2.25 on the first scale out, which only gives you a profit of 3 options of $68, a total of $204, and your initial premium back of the $157. That's cash back into your account. Later that afternoon, stock is trading. And what was the reason we scaled out here? Because it was near an old resistance on the chart, near that 322. And I said, I don't know if it's going to blow through it or stall here for right now, but let's take something off the table right now as it's at a resistance level. And if it blows through it, all the more power to us. That afternoon it did. And I didn't say, hey, let's get out at the best price. I said, let's get out at the bid, which was $575. They actually went to $605 or $595, $600. They were bid $595, and they were offered at $590. I got out at the bid at $575. So if you did that, you're out of a total of a $418 profit on another 3 lot. Guess what? Now your total profit is $1,254 plus your premium. So profit only, not your premium. You're back in the game of $1,400 before commission, almost 60% of your investment. So if you have $1,400 profit and you invested $2,000 and the stock goes to zero, files bankruptcy overnight, you're now only at a, you have your premium back plus profit. You can't lose. You're at a no-lose situation. On November 17th, Monday, the market retraces 318. I said, hey, guys, I don't know where this thing could go. I'm afraid we could go straight up and an equal and opposite, get out of another quarter. And so we had 168 times 3 for a $504 profit plus your initial premium back into the account. Now, we had the stock move up, and on November 20th, we were back up to 332. Friday afternoon, the stock went up to, what, 336 and change? Well, the open position option value was 580, 4 options net left. You can change these numbers however you want, whether you scale out was either 3s, 2s, whatever what it was. But looking at a quarter basis, this should be the overall percentage in the net results. $200, $1,200, $500, $1,962 in profits, plus your $157 premium times 9 is another $1,400. So realized cash back into your account of $3,375. Plus you now have a quarter position on of not realized profits of $1,692, which would make a total profit of $3,654 with 0 risk. Now, if Amazon trades back to 357, which is quarterly person's pivots, and if it does it by this Friday, this is the theoretical value of those options, giving time consideration of theta decay on a directional trade with those options by November 28th, theoretically, they're going to be worth around $12. It could be 11, it could be 14. You know, you never know. This is theoretics. It gives us an idea. It all depends on implied volatility, demand, the velocity, the pace of the change of the market. But needless to say, that's why theoretically we use theoretic valuations of where can an option be, because remember, it's supply and demand that also gives you the value of an option. If everyone is short those calls and the market pops and gaps higher overnight, you know what's going to happen to those options? That theoretic valuation is thrown out the window because people are forced to buy those calls, and they will go up beyond your wildest imagination. Kind of like what happened when we were liquidating our 185 spider puts when the market gap lower. We got a lot better of a fill. So same concept. Demand is what makes the theoretics throw it right out the window. But it gives you at least a guide as to where and how much your account or what you can price your options to get out at, what it should be worth. Needless to say, you will have, if the market, again, if the market gets up to that level, here's on your total trade plus your initial premium, you will have back into your account on that Amazon trade on just a simple $2,000 investment, back into your account, $81.75, which means on a $2,000 investment, you turn $2,000 into $8,000 or a $6,100 profit. I'm not sure everyone knows what this really means when we do options. That's the kind of, and maybe we need to start teaching more about position trading techniques and also looking at this, because when we go through trades and I'd say, hey, higher quality trades should translate into better positioned trades. More importantly, I'm kind of the opposite than what a lot of people teach. Some people teach trade more often, which doesn't make sense to me. If I'm trading all the time, I'm always in the market. Isn't it a fact that when you're always in the market, you're always exposed to risk versus waiting for the right setup and then go with the directional play and then be properly positioned, number one, not overly positioned, not under positioned, but properly positioned means per trade, this is the amount of risk that you should have. Now, with my style of analysis, we should be able to see almost immediate results. Now, what I've been teaching you guys with the high close, low close doji, if the market doesn't have results within the next 2 days or next 2 bars or the next 2 sessions, if it's a weekly bar, then that's 2 weeks. If it's a monthly bar, that's 2 months. If it's a daily bar, it's 2 days. So we know that we should see expected performance out of a market setup within a specific time. If not, then get out. So for option trading, that should tell you right then and there what you should be doing in a position and how you should be set up in that position. And if it doesn't work over 3-4 days, guess what? Just get out of the trade. Now, I also wanted, and I thought it would be nice to take that theoretical value and say, well, John, what if we don't use your scale out basis? And what if the market just went straight up? Okay, phones are ringing. Market just opened. All right, we have an looks like an open print there. Bill, you want to post that? It would be awesome. It looks like my eye was at 66.5, but I could be wrong. But I think that's the open print on the open outcry was 66.5. But here's the deal, just to sum this up real quick. If you bought that amount of positions, just 13 options, and did not do anything, you'd never listened to me, you went on a vacation, and by this Friday, the market does go to 355, and those options are worth exactly the amount that I specify, okay, $12, which is $1,200 each, and you're in 13 of them, you're going to net $13,559. More than double than scaling out. So I guess it's 10 to 1 to the other. Do you scale out, or do you just hang on and give that the amount of time that's needed? And you know how I've always been is more of a scale out kind of guy. And so I know that, yeah, while that's a great number, almost double the profit, I'm also reducing and increasing my capital so it's not all tied up in one trade, so that when I come up with Cisco or I come up with another trade, I still have cash in my account and I can let this market go, because, again, the key word here is theoretical. I don't know if Amazon's going to get to 357 by December expiration or after the first week of January. But let's face it, if it happens in the first week of January, those options will only be worth about 4. They won't be anywhere worth near 12 bucks. So I have, for an option, there's one thing I can't play with, and that's time. Because every day I'm in a directional trade, I lose time. Even with a trade that had 64 or 68 days to expiration, because now we've lost about 10 of those or 12 of those days off the top. All right, so with that said, I wanted to go through and give you this dissecting of the Amazon trade, and I want everyone to realize what the heck it's all about when we do this trade, or when we had the Cisco trade. And the Cisco trade only netted on the last scale out $1. And so if we're only doing a few options, you guys have to be in a percentage amount. We did great analysis in QCOM. We just didn't find a very strong value for options on that day. Whole Foods, in fact, PA Stock Alerts, I was trying to get in that thing on a stock position at a lower risk, and it just kept going up and up and up, and we lost a little bit of opportunity there. But, you know, for some of you, you may have stepped up to the plate and done a few, and of course, there was the JDS Uniphase, the Q Logic, and then, of course, all the other things that we had accomplished. So I just wanted to quickly review that with you guys and say, hey, if you're not properly positioned, if you put down just 2% of an account of stock options of 100 grand, well, then reduce that number. I don't know what that number is. If you only have 50,000, if you only have 20,000, if you only have 10,000, you have to have a portion of your account to devote to one trade. Someone came up to me at the trade show. Now, this is being recorded, and I don't have any problems mentioning this true statement. John, I've been following you for years. But I've gone to other people because their promises have been great, and I've lost with everybody. I'm looking to get back in the market. What do you recommend I do? I said, well, maybe I can help you. How much are you looking to get back into the market with? He goes, I got between $2,500 and $3,000 to get back in the market, and I'm thinking of joining a guy to do day trading. I said, then you're an idiot. I said it straight to his face. I said, then you're an idiot. You will not succeed with $2,500 to $3,000. Now that's pretty harsh, but that's the absolute true mechanics. In the day trading room, we don't win all the time. If you're trading and going to day trade crude oil or gold and trade breakouts, and you have a $600 risk and every single trade doesn't work and you do a minimum of 2 lots, first off, most brokerage firm won't even let you do a 2-lot in crude oil with only $3,000 in your account. And if they do, it's almost criminal. Because the first trade you lose on a $3 stop, on a breakout 1-to-1 risk-reward ratio, you're out $600 on the first trade that doesn't work. Now your account's down to $2,400 if you invested $3,000. If you had 2 losers in a row like that, you lost half your account. You will not be doing breakouts anymore. You will not be doing breakouts anymore because you won't have the mental capacity to do it. What I recommend you do is start looking at maybe $3,000, put in at least a 3-lot, even on a trade. If you know systematically that we look for trades that are, you know, between 80 cents to $2 in an option, I mean, you know it's going to take you time, but if we have setups, and here's what you need to plan for, and it was kind of interesting because I guess there's someone else talking and he missed this presentation, but we have a lot of things coming up and ideas to help you anticipate market opportunities. And we're going to talk about it in our room. We will be doing this. Number one, we're going to be looking at the January effect. We're going to be looking at the Black Friday and Cyber Monday retail trades this week and setting up for possibly some of them. But remember, retail trades do not necessarily include department store names like these. In fact, this was on the screen. This is kind of funny. And a guy raises his hand and he says, would that include Macy's? And I go, well, funny thing is, Macy's is right there. It's the first stock on the list, and the crowd kind of laughed. It was funny. Dogs of the year, negative performers into the middle of December tend to rebound sharply after the new year for tax credit selling pressure because it's abated, meaning they don't buy them to get into the end of the year. They keep selling them. Some of those names include Herbalife, JCPenney, Sears, and we've done those trades in this room at least 3 years in a row. We're going to look at them again, and it's the same setup. It's amazing. But we'll be looking for earnings plays coming up in the next, how many, funny thing, I think there's 25, 24, 23. There's going to be, after today, what, 22 and a half trading days to the end of the year? 22 and a half trading days. That's it. That's all we got. Mark it on your calendar. I think it's, I could be wrong, maybe give or take a day. 22 and a half trading days. And out of those 22 and a half trading days, 5 of them you shouldn't be trading because this trading room is going to be closed. And it's the week between Christmas and New Year's. Closed. Don't even come here. I'm not going to project. In fact, Friday, the room's closed. No projections. Unless, Bill, you want to do it. and you want to come in, but this room is closed. Mandatory, people take off and reflect and come back with time. Relaxation in both from a psychological aspect, and look back and maybe study some stuff. Take Friday instead of trading to rehash some great material that we've put out for you guys. That would be more productive than sitting in a trading room watching a day trade setup, I think. Hopefully that is great sound investment advice. If you are going to devote money, time to the market, then be constructive about it. You know, if the market doesn't have a great day for trading, or you're in a position trade, let the position trade work for you, not you working for the market. And therefore, use that time. If you feel like you need to be in the market and you need to devote time to trading, then use that time to study rather than to actual trade, a day trade, when it's going to be thin conditions. Another trade setup is copper begins a seasonal. So we might be looking at the setup in copper. So these are ideas to help people. So a guy with a small, paltry $3,000 account can actually take that position size formula, $3,000, 2%. That's not a lot, so you got to bump that number up, but maybe only use maybe 10% of the market, so that's $300 per trade. He would have been able to do two options. So instead of scaling out on a quarter, he would have scaled out of a half. And even if he didn't like the market, think of it, if he scaled out at the first scale out, at 225, he made $68 profit. If he got out the second scale out and was flat, he made a total of $500 on a $300 investment. His account would be from $3,000 to $3,500. If you do that just once a month, where's that $3,000 going to be at the end of the year? $9,000. So if you're looking to get rich and sustain a $5,000 a month income is what you need to trade, if that's what you need to live on and you think you're going to live on that by day trading a $3,000 account, I argue I've rarely seen that done. I've seen it in email marketing headlines, but I haven't seen it in real life. But in any event, I want to go over and say I wanted to take this time to say this is a kind of an interesting week in the markets. Seasonally, the market does move a little bit higher into this week. The market may have already moved that. We still have, despite what I've been looking for in the market on a very weak volume rally, the advanced decline did certainly perk its head last week with, of course, the Chinese interest rate move. The NYSE is still at a potential with all of that news and all of that strength in the market. We've yet to see a confirming breakout in the NYSE. So I think that possibly what this is more of that sector rotational grind in the marketplace. I do have my eye on looking at the diamonds. I think the lack of follow-through, or at least from a sense of why we saw a new high in the S&Ps and the Qs and the diamonds, NASDAQ composite, but yet not in, of course, the Russell. And this could be, as you can certainly see, why we've not seen the market break out and take a new high yet in the Russell. These are still concerns that I have, and if we do get that sector rotational grind, we'll see maybe a pause in the S&Ps, a pause in all the other markets, and yet this seasonal event will start taking over in the Russell. So I'm looking for more upside potential in the Russell going forward. This is the on-balance volume indicator, which actually looked a little bit more constructive on this little move up here on a daily basis. The advanced decline did not. So this is kind of like the one sector that's the opposite of strength. It's actually a laggard, but we come into seasonal strength in the next 2 weeks, 10 trading days. Let me just put that into terms for you, 10 trading days. So perhaps we see this sector pause and this sector outperform. So we will be paying attention to that. That concludes my weekly planning and scanning. I will have a weekly market outlook out later this afternoon. We didn't, for obvious reasons, have time to create one or write one on a announced bumpy ride all the way from Las Vegas to Miami. And in fact, I think we had to go from 35,000